Good morning, ladies and gentlemen, both those in the room and those listening remotely, and welcome to the presentation of Redefine International's results for the six-month period to 28th of February 2015. At our last presentation, we outlined the very positive achievements made by the company in meeting a demanding programme of objectives set during 2014. Those achievements put the company in a strong position to continue to deliver on its strategy of becoming a leading, income-focused REIT, and I'm pleased to say that the high activity levels have continued this year. We've made a number of significant and attractive acquisitions, including a portfolio of 56 German retail properties. The timely disposal of non-core assets into a strong investment market has continued, and the portfolio is now entirely focused on Germany and the UK. Significant new capital was raised through a successful share placement, and the board has further been strengthened with the addition of two non-executive directors, Elizabeth Thiemann and Robert Orr, who between them have an immense amount of experience, particularly in the core markets of Germany and the UK, where our focus now exclusively lies. The company's continued focus on income growth is unwavering, and today's results represent another solid step for the company, as both the portfolio and capital structure are again much stronger and more resilient going into the second half of the year. Against the improving economic background and increasing tenant demand, the strategy and asset management initiatives being undertaken by the company provide cause for optimism. I will now hand you over to Mike Watters, Stephen Oakenfold, and Adrian Horsper to take you through the financial results and operational progress we have announced this morning in more detail. Thank you very much.
Right. Thank you, Greg, and good morning, everybody. This is our 19th half year as a listed company, and I'm pleased to report that the company has never been in better shape. It's been an active 6 months, and I aim to cover the highlights of this reporting period before handing over to Stephen and to Adrian, who will report on the solid results and excellent progress within each of the business silos. I'll then touch on our Cromwell investment before closing off with our pipeline of deals and business strategy and the longer-term vision for the group. Now, to start, I'd like to assess our performance against our key focus areas. As you know, the delivery of sustainable and growing long-term income is our major objective. So I'm pleased to report that our reputation and ability to provide sustainable and growing income returns to shareholders has been enhanced. Our distribution growth of CPI plus 1% has been achieved, and in fact, it's been bettered. NAV has grown despite full earnings distribution and a number of headwinds, including foreign exchange. We are in the mid-range of our balance sheet target of 40 to 50% NAV, which is very pleasing. And the capital markets are supportive of our business model, as can be seen by the large premium at which we trade to our net asset value. As a result, it's pleasing to report that the market cap has grown by over 30% since the same reporting period last year, to over 800 million, with enhanced liquidity and strong shareholder support, for which I thank all our shareholders. Moving on to the specific highlights for the period, there's been continued growth, and our earnings available for distribution has increased by just under 20%. Distributable EPS is up by 5.2% to 1.63 pence, and a dividend has been declared, which is 6.7% up on the same period in 2014. As referred to in the previous slide, the balance sheet has seen less positive growth due to a number of headwinds. These include the write-off of acquisition costs, negative foreign exchange movements, and a value write-down on some sold non-core legacy assets, which Stephen and Adrian will take you through. On the positive side, the balance sheet was strengthened through a new share placement, in which we raised £71 million at a premium to net asset value, with the adjusted NAV rising to just over 42 pence, which is 4.6% up. As I said earlier, the pro forma loan to value is now right in the middle of our target range of 40 to 50%, which we are very pleased about, Obviously, the closer to 40% we could get in the medium term, the better we will feel about that. And we have unrestricted cash balances, which is a positive and a negative of approximately 72 million. And we'll talk a bit later what we're going to do with that cash and how we're going to invest it. On the corporate side, we transferred our listing category from a Chapter 15 to a Chapter 6, giving us a status more in line with the actual business model under which we operate. As Greg said, two high caliber NEDs have been appointed, and we're very pleased to have them on board. On the property portfolio, the UK asset valuations increased by 2.1%, European asset values in euros by 0.4%, and the occupancy, very pleasingly, has remained steady at a very high level of just under 98%. We've been busy on the asset management side. The agreement for lease with Primark at Ingolstadt has been signed, and we now have to deliver a new store, which will take approximately 12 months. And we're very excited to have Primark as our second Primark in a very large shopping centre in Germany. Western Fayville is underway. Adrian will talk a bit about that, which is great because we've got a rental recovery coming through at the same time we invest in capital. And similarly, in Birchwood, where we spent 6.5 million over the last 2-3 years, we're going to ramp that up by putting in some more stores again. Adrian will take you through that. And lastly, on the asset management side, we've agreed a new deal with Travelodge to extend the Enfield Hotel by 21 rooms, and that we're about to start on site. That's all at the margin, but good stuff in our existing portfolio. On the capital recycling side, we acquired the German portfolio, which we're very happy about. Great asset. The Doubletree Hilton in Edinburgh is proving to be a sound acquisition, performing to expectations. And Delta Assets, we acquired the last 3 assets out of the CMBS, Lehman Brothers CMBS, and that is now the end of that saga that we took over from Whitford when we merged with Whitford. And we're now pleased to report that the legacy side of our business is largely wound up. And just lastly, Greg did indicate that we're now solely in the UK and Germany. It's not quite right because we've exchanged contracts to sell the Swiss co-op properties, but we'll only be completing that in August this year. So I think on that note, I'll hand over to Stephen, who can take you through finance and operations.
Thank you, Mike, and good morning. I'm pleased to report a strong set of results and continued progress on key operational measures. Notwithstanding the adverse movements in the euro and Australian dollar, we've made very good progress in terms of earnings, net asset value, and the strength of our balance sheets. Looking at the distributable EPS in more detail, gross rental income was 34.3 million, or 2.62 pence per share. The Cromwell distributions totaled 3.7 million, net of withholding tax. And just for your information, the distributions have been hedged, or the FX has been hedged for the remainder of our financial year. Income from associates and joint ventures includes 0.26 million, which reflects our 25% share in the hotel management business. And other income includes fees from JV partners, which continues to be an efficient use of our balance sheet and asset management resources. You'll note that this is the first period in which we don't have investment advisor fees following internalisation, and the EPRA cost ratio, excluding direct vacancy costs, of 16% compares favourably with REITs of equivalent size in the sector. Net finance costs reduced to 31% of gross revenue, and again, this is a reflection of the deleveraging that's taken place on the balance sheet. Overall, the distributable earnings per share of 21.4 million, or 1.63 pence, was up 5.2% on the same period last year. Again, we feel this is a very strong result given the headwinds from FX movements and the negligible returns that we're receiving on cash at the moment. A dividend of 1.6p has been declared and will be payable on the 5th of June. Turning to the balance sheet, if we start from the August 2014 EPRA NAV of 37.66 pence, I'll take you through the key movements during the period. There was a small net impact resulting from scrip dividends issued at a premium to NAV, offset by 4.3 million shares in respect of LTIP provisions. The distributable earnings per share for the period of 21.4 million broadly offset by dividends paid of 22 million, and the dividends being paid in respect of the final 2014 period. And as you'll be aware, the final dividend has historically been higher than the interim dividend payment. I'll come on to portfolio valuation separately. However, the balance sheet, assets on the balance sheet added 8.6 million, which was offset by foreign currency translation reserve movements of 6.3 million, owing to the decline in the euro. The legacy negative equity adjustments, as Mike referred to, have reduced considerably to 37.7 million, or 2.8 pence per share. And as expected, these will be entirely removed by year end, following which there'll be no further requirement to report an adjusted NAV figure, and that will be in line with EPRA from now on. The capital raising, which completed just after the 28th of February, was very well supported, and that has been reflected in the pro forma NAV, adding just over 1 pence per share to give us a final figure of 42.4, up 4.9% from August 2014. Turning to the valuations in a little bit more detail. On the UK retail side, we had some strong valuation performances from our core shopping centres, ranging from 2.4 all the way to 8.7% up. However, the overall performance was held back through Coventry and Crewe being sold after period end. On the UK commercial side, that was up 4.5%, reflecting appetite for higher yielding regional assets. And the hotels up 1% overall, but similarly to the shopping centres, there were quite large variations within the portfolio, and the general trend is very positive within the hotel sector. Europe was up 0.4% in local currency, the decline in sterling obviously reflecting the decline in the euro during the period, and the market value of our Cromwell holding increased 4.1% during the period, 16% at a local currency level, but 4.1% when taking into account the movement in the Australian dollar. On the capital management side, as Mike referred to earlier, we've made very strong improvements here. Our pro forma see-through leverage is now just over 45%. Our weighted average debt maturity well over 9 years, and our weighted average interest rate of 4.4% has come down marginally, and we expect this to come down further with the refinancing of the recent German acquisition, which at a margin of 1.2%, we're expecting to refinance very shortly at an all-in cost of close to 1.5%, or maybe slightly better. There are a few opportunities to reduce the cost of debt further. As we've shown on the slide, those green boxes mark the interest rates associated with debt facilities maturing in those periods. And I think of particular interest is the Australian facility against our Cromwell holding, which currently has a cost of 7%, and then perhaps some of the longer term facilities in 2018 at 4%. There's a good opportunity to reduce our cost state of the banking market. We're also actively assessing the capital market opportunities and to improve the structure and our long-term cost of debt, and this would include the possibility of more unsecured debt over the medium term. Moving to our capital allocation slide, this is just an update of what we presented in August. The UK is still roughly 2/3 of the portfolio, with retail representing about 30% of the total. Hotels remain at about 20% following the acquisition of the Doubletree Hotel in Edinburgh. And our focus in Europe remains almost exclusively on Germany, with just under 1/3 of the portfolio there, with a very large focus on retail. Cromwell is now just under 10% of our asset base, and Mike will come on to talk about Cromwell in more detail shortly. And then in terms of income visibility, this slide we present every year shows our expiries by gross rental income, which is the earliest possible break from tenants, including tenant break options. And I think just to highlight the key changes, particularly in 2016 and 17, where we've seen an improvement. The figures previously reported in August were 8.2% in 2016 and 6.6% in 2017. And as you can see, that's been reduced by a fairly healthy margin. And now the overall lease expiry profile is very manageable, we feel, and no particular expiry risks in any one of the next 4 or 5 years. Lastly, we're making very good progress on consumer and brand engagement. We have included a slide within the appendices, so I'd encourage you to go and have a look at that. But we've had very positive results from our digital and online initiatives, and we're making very strong progress there. And on that note, I'll hand over to Adrian to take you through the property portfolio in more detail.
Thank you, Stephen, and good morning. I'd like to start with a quick overview of the market, if I may. So demand for property remains strong, with the UK institutions and overseas investors being the largest net buyers. With the amount of money pouring into the retail funds, it looks likely that pricing on the institutional sector will experience further yield compression. And the secondary sector continues to be supported by a range of bidders, matched by relatively willing bank lending. On the occupational side, rental growth is back in positive territory in the main sectors, although outside London it's relatively elusive outside the main centres. I'd like to start with a quick helicopter view of the portfolio. Starting at the top left-hand box, 27% of the portfolio is invested in London, and 14% is within the top German 5 cities. So that's Berlin, Hamburg, Düsseldorf, Frankfurt, and Munich. So we've got 41% of the entire portfolio is within London and the top German cities. 43.6% of the income within the portfolio is indexed, and we have a 9-year WALT within the portfolio. The income gain figure of 1.3 million, this is a measurement taken from August 2014, so the year end, to February 2015, the half year. And it measures the income that we've gained from letting vacant space and the reduction in landlord shortfalls as a result of those units being let. So it's a combination of those two factors. And that goes straight into our NOI. The position as at today, so updating that number post the February period, is we're now at 1.984, assuming the units that we've got under offer exchange, which will be a 42% reduction since August last year. We've had a very busy period both within the portfolio and on new transactions. The key acquisition during the period was, as already referred to, 156.8 million euros of supermarkets in Germany, 56 units, 1.379 million square feet of space, bought in joint venture with Redefine properties. The net initial yield at 7.25% shows a return on equity of 11% post refinancing, and the tenants, Real, Edeka and Netto, are among the top operators in the German food market. The rents are indexed to 65 to 70% of German CPI, with 85% of the total income being from units located within West Germany and Berlin. The WALT within the portfolio is 10.3 years. Now, at the time of acquisition, we had asset management plans to extend units and extend leases. I'm very happy to say that we're well on the way with those negotiations, which is probably a little bit earlier than we thought we would be, so that's an encouraging sign. And further to that, we've had unsolicited interest on a number of the properties within the portfolio, and some of the bids are in the range 15 to 20% above purchase price. So I think it shows that this is a sector that's continues to be in demand amongst investors. Looking at activity within the centre, I'm just going to touch upon one or two of the key asset management plans that we have been working on. I'll whistle through these fairly quickly. Western Fayville, Northampton. This is a food-anchored convenience centre in a densely populated part of Northampton, 98.2% occupied. We have got planning permission. We're on site now. We are extending and reconfiguring ground floor, the lower mall units, and we're improving the aesthetics in the upper mall and the lower mall, both internally and externally. The total spend's about £4 million, and that includes works that will be contributing towards a phase 2. Phase 2 will be improving the anchor at one end of the upper mall, and we're in the design stage for phase 2 at the moment. Externally, I think I referred to this last time, the yellow line that you can see there, we've been working with the county council. That was a former school. The school is now, if I can work this thing there. This site now has planning permission for residential, so we're going to try and encourage them to get on with that, get one of the housing majors in there to build houses. More houses, more footfall, more people in the shops, rents the residual of economic activity, so rents hopefully up in due course. Where we've got marked on existing leisure and cinema gym, we're working with the Borough Council there, and we've had a further discussions this week. We want to try and bring that into the shopping centre. If we can get the leisure offer within the shopping centre, we can bolt on a lot more restaurant uses, increase dwell time, increase income from more restaurants. Crescent Centre in Bristol, this is 88,000 square feet within the Temple Quay area of Bristol. It's the major central business district of Bristol, and you can see from the dots there that we've got Deloitte, HSBC, Canada Life, a lot of big operators, occupiers, in this location. We're number 5 on that plan. Our building is a good quality air-conditioned building, but it's let down by poor tenant amenity within the building. We're at the pre-planning stage for a scheme to spend £2 million on the building. Greatly improved reception, bike storage, shower facilities, cafe, meeting area. We've had a meeting with the tenants, they're all very positive about it. The rents in our building are £11.50 per square foot. Rents in this location are just under £30 per square foot. We're targeting £13 to £15 per square foot, which is going to be a 10% marginal return on equity, and will still be only 50% of rents in the locality. So very keen on that scheme. Birchwood at Warrington, a food anchored discount scheme in a residential area with Birchwood Business and Technology Parks nearby. 93.3% occupied, although that does include units that we're holding vacant because we're going to demolish the buildings for the new scheme. We're at the pre-planning stage again on this one. 2 new units and restaurants as well. An estimated return on cost of 8.5% with a cost of £5 million. The £5 million does include works to other parts of the shopping centre, so it's a slightly reduced yield on cost as a result of that. We're at the pre-letting stage, and at this stage we are looking like on the retail element will be 180% of the rents we achieved 2 to 3 years ago on comparable adjoining units. A great example of where the retail market is at the moment. The discount retail sector in the UK is going great guns. St George's Harrow, fashion and leisure anchored scheme in a London commuter suburb, 98% occupied. 2 things underway. We've got negotiations underway at the rear part of the centre. We have agreed with one of the anchors to downsize them, and they've got board approval for this deal. And this is as a result of interest from a fashion retailer coming in and take space. So we're just going to try and close on those negotiations, which would be good for the centre. A great footfall driver with a new fashion operator at the back. On the yellow and green boxes, that's that one and that one. Those sites were bought in the period by a residential developer, £25 million. They are converting the yellow office building into residential at the moment, and they've approached us with regard to the green land to do a mixed-use scheme with them doing the residential, us doing retail at ground floor. We've spoken to a number of big box, well-known fashion retailers in the UK and had a very positive response. So we're at the moment working out plans for a scheme there. Moving on to Germany. We've already spoken about the Primark pre-let. Ingolstadt, this is a satellite town to Munich, affluent location. This was originally acquired as a mall of units with an adjoining Hennes and Mauritz. We'll be redeveloping within the envelope of the building to provide 2 large floor plate fashion units, an enlarged Hennes and Mauritz and a new Primark. Great scheme within an affluent town. A rental base of €17.35 per metre square per month, and we're just sense checking that at the moment, but it does look to be a very good base for growth going forward. Finally, moving slightly into the medium term, the Bahnhof-Altona shopping centre in Hamburg, convenience scheme, linked to the railway network, the high-speed network and the underground network, and in a great position in retailing terms, put in a brand new IKEA and a brand new TK Maxx, those units there, and the existing Mercado Centre and retail pitch. So we have great chemistry, great footfall along our mall. We are working on a scheme in conjunction with the local authority. The plan is, and this sounds negative, but it's actually positive, but the plan is for the high-speed rail network to close. We don't get much footfall from it, and this will allow us to expand into these green areas, our bit is the red area. So we own that bit and that bit and that bit and that bit. Those are the bits we wanted to expand into. We're talking to a large floor plate fashion retailer, and we're likely to do this in phases. And it's allied to a scheme where the yellow land is at the top here, which is the second largest urban redevelopment in Hamburg, 1.2 million square feet, largely residential. And between the two, there'll be a parkland, and this should be, for the future, for the medium term, a very exciting scheme for us. That slide will aim to use this each time now going forward, and that just summarises what I've just described. It's by no means all the schemes that we've got underway. There are a whole host of smaller schemes, but that's the main ones that we are working on. I'll touch briefly on hotels. The underlying performance is good, albeit, as Mike mentioned, we have suffered some drag in the period from the acquisition costs on Edinburgh. And we've got one hotel that has experienced new competition, so that's going to have to bed down again and rebuild. And then finally, to close, with regard to new acquisitions, we remain opportunistic. We haven't found it very easy to find value, but we do remain disciplined, and we are true to our principles of following the property fundamental, provide a growing dividend yield with capital appreciation by asset management. We have bid on numerous investments in the last 6 months, but we've stepped out of the process when we feel pricing is too high to achieve our goals, and we will continue to do that when we don't feel that the price matches the goals that we're trying to achieve. We've got a number of negotiations underway where we feel that we can achieve our goals while maintaining a strong underpin to the property fundamental. I hope that gives you a feel for what we've been up to in the last 6 months. We are extremely busy. We're working on existing assets, reducing voids, and then appraising new opportunities. And I look forward to updating you when we meet again after August. Thank you.
Thank you, Adrian. Moving on to Cromwell. As we've highlighted in the past, Cromwell is a legacy investment from 2009, which has performed extremely well for us. And I would just like to point out that we have made it clear before that we will re-look at our investment in August, well, at the end of August, because there's a 12-month period which, if we hold less than 10%, we would be able to sell the stake without incurring CGT. The performance has been very, very good from Cromwell. The distributions have been strong at 3.7 million. The market value has increased substantially in Australian dollar terms, albeit that we suffered from a declining Australian dollar. And we have hedged our distribution so we can be pretty certain of what our income is going to be for this financial year. The underlying performance has been good. The distribution has grown by 3%, and the gearing is now reduced to 36%, although what we have seen now is that they have acquired Valid, and they've issued a convertible bond to acquire Valid, and Valid is going to add approximately 5% to the Cromwell earnings. Now, Valid is when I say Valid, it's Valid Europe, which is focused on the UK and Europe as an asset management entity. There's no balance sheet investment that's going from Cromwell into Valid. So I think from our side, our shareholding is there. We're earning a very good return. We should get an increased return of approximately 5% from the acquisition of Valid. And we will reassess the position after August and then take a view as to whether we sell or not. And clearly, what we're going to have to do is to reinvest that money. It's about £100 million. We're going to have to reinvest it into something that gives us an incremental return. So the pressure's on to be able to find those opportunities. And if I then can move on to that very point, and that's to look at the outlook going forward the way we see things. So looking forward, our focus will continue to be providing distribution growth of CPI plus 1 to 2%. We are more focused on income and the growth in the income and sustainability of the income as opposed to net asset value. We're an income-focused fund, not a total return fund. So often analysts and commentators make a very strong point about net asset value. We are focused on income. How are we going to grow that income? Well, if we look inward, as Adrian and Stephen have pointed out, we've got rental growth appearing in our key markets, and that would be discount, convenience retailing, limited service hotels, and regional offices. We've got development and we've got asset management, which is all very, very, very good for accretive earnings, so we'll focus on that. And then externally, the capital markets, debt and equity, are very supportive on earnings and NAV accretive acquisitions. The problem with that, they're supportive for our competitors as well, so it makes buying a well quite difficult. But we do have a strong balance sheet. We've got cash, we've got liquid investments, supportive partners, and that gives us a lot of optionality. The pipeline, besides the CapEx program, where we got 20 to 80 million over 2 to 5 years that we'll spend, we do have heads of terms agreed for a brownfield development in the city. It's with a well-known developer that we've worked with before, and we're hoping to be able to announce that the investment will probably take up to a 50% stake on a joint venture basis within the next probably 2 to 3 months. As I say, we have got heads of terms agreed. It's quite a complicated transaction, but that's one of the exciting deals that we are working on. That will use some of the 72 million. We then have a couple of deals we work on, mixed-use UK portfolio and quite a large German shopping centre. The German shopping centre is a competitive process. Our view is there we'll bid, but probably be outbid by somebody. So that's a long shot, but if we do get it, it'll be a very nice acquisition for us. So on the outlook side, the economic environment remains uncertain with Grexits and Brexits and all that type of thing. But we know we've got a quality portfolio, and through whatever comes through, whether it's election or Greece or the euro or quantitative easing, we think we're going to be fine to enhance our earnings going forward. With a strong balance sheet, that can only help. And I think, as I said, to deploy the cash in a strong market where pricing is high, you've got to be nimble, and we'll make sure that we find the opportunities to add the value without overpaying. So I think we're well positioned for any outcome. And I'll just close off with a quote that in an era of seemingly limitless supply of capital, we have to remain energized to stay ahead of the competition. And we're confident that we're in a strong position to do so. So after 19 half years of reporting, we've never been stronger. Hopefully, going forward, we can say the same at year end. That's our presentation. We'd now like to open the floor to questions. Jan.
Hi, Sam Woodward from Merrill Lynch. Just firstly on the distribution guidance, sort of CPI plus 1 to 2%, do you think about that on an underlying basis, or does that include sort of inorganic growth that you can get from acquisitions and so forth?
In a low growth environment, we have to look at all ways to do that. So it's new acquisitions, it's accretive development, asset management, it's clever funding, it's all of the above.
And just on the Vallard Europe acquisition by Cromwell, does that have any sort of strategic implications in terms of your role as a partner for Redefine properties in Europe? Any other sort of collaborative opportunities? I mean, granted, they're a funds manager, but I imagine they also have a strong network on Europe, may turn up interesting opportunities. Is there a sort of formal collaboration that can take place?
There's nothing formal. We have met them, we know them, we work closely together. Nothing has come out yet, but I've got no doubt that there could be opportunities going forward, and we hope to work with them. We don't see it as a strategic issue because Redefine has made it clear they're investing in Australia through and with Cromwell, and in Europe and the UK through and with Redefine. So that's we don't see it as a strategic issue from that point of view.
Great. And then just a question on your lease expiry profile from slide 11. Just wondering if you can give a bit more colour on the sort of UK retail expiries in the next couple of years, because I think that's the sort of the biggest chunk of what's expiring. Just any other sort of colour you can give on that?
I think the most important point is that there's no major exposure to any single one tenant. So there's a lot of diversity within, particularly the 2016 expiries. A number of shorter term lets at places like Coventry and Western Favell, where those are typically being rolled. So we look at this very closely. Clearly being focused on income, looking at our lease expiry profile on an ongoing basis is critical, and we don't have any particular concern for those expiries.
And no particular one tenant, but any particular, is it mostly Coventry and Western Favell that make up that, or is there any particular weighting to any one asset?
No, Coventry and Western Favell probably make up about 60% of that.
Thanks.
Hi, it's Jan Willem from JP Morgan. First question, Mike, you said that you're very happy to lower the LTV to around 40% in due course in the coming years. Does this also mean that the dividend yield at net asset value will therefore decline a bit, because it's always a bit of a balancing act, leverage on the one hand and then dividend yield on the other hand?
Yeah, as I've said before, the loan-to-value ratio will move, not because we're going to raise expensive capital, expensive equity to pay down debt. Loan-to-value will move over time where asset values increase, and when we gear new acquisitions or do developments, we'll do that at a lower level. So we don't see our debt level declining on a gross basis. We see asset values increasing. And what we look at for every deal we do is to ensure that every deal is accretive from a net asset value and earnings point of view. So I don't think you could deduce that by reducing loan to value, we will impact our earnings. We won't do that.
Maybe a question for Andrew. Would it be possible just to get a sort of feeling on ERV growth across the portfolio, sort of on average level, so where you see sort of average ERVs going, or where they have gone?
Yeah, I think on the if we look at the UK first, in terms of retail, we're seeing marginal ERV growth. I think if you just look at it anecdotally, I think at places like Birchwood and Seaham, we're starting to show some very good evidence, as Adrian pointed out, with respect to the new lettings to discount retailers. So I think at the moment that's low single digits. On the hotel side, as we indicated last year, rents were increased about 4 to 5%. PwC are expecting RevPAR growth of about 5% again for 2015. And then in Germany, it's very moderate growth, 1 to 2%. But again, that varies quite substantially across the portfolio. If we look at our major centres, so Berlin and Hamburg, we are seeing growth on new lettings there of about 1 to 2%. Within the food store portfolio, it's probably relatively flat at the moment.
Maybe last one. If the investment market continues to be very difficult and just tight, would it be an option just to go for early refinancing, so breaking some swaps and going for the 16-17 refinancing?
Yes, I think that's something that we are actively looking at the moment. I think it comes back to my comment about looking at our longer term debt structure as well, and potentially looking at ways in which we can perhaps move to a more unsecured structure over the medium term. I think coming back to your earlier question to Mike, I think, we're talking about reducing leverage and how does that impact earnings. I think we are at a unique point in time now where the cost of bank funding, you can leverage at relatively low levels and still have very earnings accretive investments. We're looking at a couple of options in Germany at the moment where margins are below 1%. And in the UK, I think for anything vaguely resembling a fundable asset, you're looking at 1.5%, sometimes better. So obviously there's an opportunity to reduce the cost of funding.
Perfect, thanks.
Morning, Kate Wren from Peel Hunt. Have there been any particular comparable transactions in the UK which could signal further yield compression, particularly for the hotel assets?
That's a very good question. The value of our assets across the board on a per room basis bears no resemblance to the activities that are taking place at the moment. And there was a hotel, albeit a special purpose hotel in Shoreditch, which sold, I think, about a month ago for £580,000 per room. Our average valuation will be that we are a limited service sector is on about the 150 to 200,000 pounds a room. So the underlying real estate of our hotel portfolio, even if you look at it on a residential conversion basis, is very, very high, but it's not been reflected in the valuation right now. So I think from our side, we are very happy that we've got a built-up asset portfolio that's going to increase in value over time if we had to put it onto the market. But as an earnings portfolio, that's what the valuers think it's valued at, which is fine, because we're not selling it, we're just holding it, and maybe our net asset value should be a bit higher if we sold it into a very strong market. But we're happy with our portfolio. It's earning us a very good return, and over time, who knows? We could convert it all to residential, or knock them down and put different types of hotel properties on them. So it's intrinsically a very, 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 very valuable asset that we have, this portfolio. Mr. Carter.
Yeah, thanks, Mike. Can I just ask about the German retail portfolio, which is that you acquire very, very small lot size, 65-75% rental linkage to CPI. So presumably that's going to be flat or positive, even a negative number. Given you said that you'd received unsolicited bids 15-20% above the bought price, presumably the temptation to exit some or a lot of that is very high, or are you constrained by the fact you need the earnings?
It's always tempting to take offers that are 10, 15, 20% higher than you've just paid. But I think, again, our constraint at the moment is not capital. Our constraint is opportunities. And if you set your stall out to grow your earnings at CPI plus 1 to 2%, you can't sell all your assets. You need the earnings. So I think there's a mix here. We will sell those assets that we think are at the end of their life cycle, and we've got a list of probably 20 of those that we'd like to sell, and we'll do it on the basis that we can reinvest that equity into other accretive earnings opportunities. It's a balancing act, but our stall has been set out that we will deliver CPI plus 1 to 2% per annum, and we will do that, and we'll balance the portfolio within that constraint.
That begs a few questions. So going forward in terms of earnings growth, do you see more scope from earnings growth to come through debt refinancing than rental growth within the retained portfolio?
At the moment, we're in a low growth environment both in the UK and Germany. That's just the way it is. Deflation is rearing its head. So rental growth is pretty static. We think in due course rental growth will return. But in the interim, there are opportunities for us to grow our bottom line income by refinancing, doing more accretive deals, recycling capital. We think we got good at recycling capital, and we continue to do so. The fundamental issue of just buying a property and sitting there looking at it while it grows the revenue stream is not as easy as it was perhaps in a high inflation environment, but then you had other issues like high nominal interest rates. So we will continue to manage our portfolio to ensure that we can get growth. May not be underlying rental growth, but it will be bottom line growth.
Thanks.
Mike.
Mike Bessel from Bank of America. Just following on from that, looking at slide 9, particularly the 4% GDP debt that you have outstanding, how do you think, given your income focused, how do you think about the trade-off between an NAV hit from breaking that facility earlier in order to be able to refinance at a lower rate and therefore boost earnings? So as we look through that pipeline, how does that trade-off work for you guys?
Yeah, we had some. Sorry, we've had some interesting discussions on this with shareholders in particular. I think perhaps in the previous cycles, the sort of question of breakage costs to boost your earnings was was not particularly acceptable. I think we're currently in an environment, particularly in low interest rates, where the premium that people are placing on income, shareholders and investors seem to be more happy for companies to do this. So it's something that we are looking at closely. I think what you also need to look at is whether by breaking that cost, paying those break costs now, you are securing that longer term interest rate. And, at the moment, it looks like interest rates are going to stay low for a long period of time, but, we may get to 2018 and the world may be very different. So I think it's not so much a case of necessarily boosting your earnings for a capital value decline, but it's a case of looking at securing that rate now, given the banking market that we've got.
And for those of us slightly less familiar with the day-to-day movements in the Australian banking market, where will you be refinancing the Aussie debt at current market levels? What are the bankers telling you?
The Australian interest rates have declined since we fixed probably about 2 years ago, continued to decline. The forward rate curve is lower. We're not entirely sure we're going to be refinancing that debt. It has a maturity, I think, in April 2016.
Yeah, and I think that the point with the reference to the 7.3% cost of debt, I think if you compare that to the dividend on the share price, just means that it's not a case of just looking at the gross yield on Cromwell. It's the return on equity in terms of investing that elsewhere.
That Australian debt was put in place as a natural hedge against the currency. So on the one hand, you are losing through Australian dollar weakness on your investment, but you're gaining it on your liability. So that was half the reason it was put in place.
Are there any questions on the phone?
To ask a question over the phone, please press *1 on your telephone keypad at this time. We actually have a question now from Leon Allison from Macquarie. Please go ahead, Leon.
Hi, Mark, Stephen. Just want to find out your payout ratio increased during the period. You previously indicated you'd like to gradually lower that to around the 95% level. What can one expect for the full year or the near to medium term?
Leon, I think the consensus at the moment is between 3.25 and 3.3 pence for the full year. Obviously, it would be nice to reduce the payout ratio and still be within that range. So that's where we would aim to be at year end.
Okay, thank you.
Okay, thank you. There are no further questions over the telephone at this time.